Hi everybody and welcome to another in our series of revision webinars looking at key core topics in A-level economics ahead of the June 2017 exams. This session is going to focus on the balance of payments, and as always we're going to kick off with a few multiple choice questions. Have a go if you're watching the YouTube version of this webinar. Always press the pause button, have a go at the question, and I'll come back in a few seconds with the right answer. Here's the first question. In 2016, what was the final value of the UK balance of payments? Was it a deficit of 80 billion, a surplus of 45 billion, zero, or was it impossible to calculate? Press the pause button. I'll be back in a few seconds with the answer. And the correct answer to this question is zero. The balance of payments always balances. Individual component parts don't necessarily have to balance, but the balance of payments always balances, as we'll see in a few minutes. Question 2. A foreign government pays a UK university to educate its students. How would this be recorded on the balance of payments current account of the UK? Have a go. I'll be back in a few seconds. And the correct answer to this question is C. Yes, education counts as a service, so foreign students coming to the UK effectively represents a service export and an inflow of money into the UK on the current account. Question 3. At a time when international demand for oil was high, Bolivia encouraged investment by foreign firms in order to exploit its oil and gas. What overall impact would this have on the balance of payments of Bolivia? The correct answer to this question is C. There's a degree of uncertainty. The Bolivians, of course, may well get the foreign investment coming on the financial account. Equally, they may well export some of the oil and gas which is extracted from Bolivia, but the profits of foreign investment to foreign companies basing themselves in Bolivia may, of course, leave the economy. That will be a negative on the balance of payments. In other words, there's going to be quite a few inflows and outflows of currency as a result. So there's uncertainty. Keep in mind that in most multiple choice questions, anything which says the word definitely is nearly always wrong. Question 4. A Japanese car manufacturer established a successful factory in France. How would this be shown in the Japanese balance of payments? And the correct answer to this question, question 4, is A. The Japanese balance of payments, the investment counts as a capital outflow from Japan, but of course hopefully this investment was successful, will have made profits, so the profits will flow back into Japan on the current account. We'll go through the current account in a second or two. Here's question 5. A country's government wishes to switch demand away from private consumption towards investment and net exports. Which combination of policy measures would be most likely to help it achieve this objective? And the correct answer to this question is B. We're looking to increase investment, we're looking to increase net exports, in other words, an improved balance of trade. So a lower interest rate should help to stimulate investment, cheaper for businesses to borrow to fund their capital spending. And of course, lower interest rates might lead to an outflow of hot money, which would cause the exchange rate to depreciate, and that would help, hopefully, the balance of payments. Increase in VAT would cut real incomes of consumers and therefore probably subdue consumer spending, helping the switch away from private consumption. So the best answer there is B. Okay, hopefully you did okay on those questions. You can always go back over them again by just rewinding the YouTube button. We're going to look at the structure of the balance of payments in the next section of our webinar. So here we go. The current account is the part of the balance of payments that typically students study in their first year of macroeconomics. And the current account is the balance between trade in goods, trade in services, net primary income, we'll go through that in a second, and net secondary income. So the X minus M that you may be familiar with, the C plus I plus G plus X minus M, is the trade balance used when calculating aggregate demand. So the current account is basically asking a question. It's saying, is a country paying its way internationally? Is it earning enough money from exporting goods and services, and maybe earning income from overseas investments insufficient to pay for the imports of products that they need, and also maybe to pay for aid transfers or other kind of outflows? So if we focus a little bit more on the current account, so the trade balance in goods is typically tangible physical products like TV screens and computers and iPhones, and energy products, oil and gas, basic raw materials. Trade in services is of course wide ranging, from banking to insurance and business consultancy. Tourism is a key trade feature for many countries. Logistics, shipping, education of course, both schools and universities, healthcare, the rise of health tourism, research and the arts. Britain is actually the biggest exporter of cultural services in the world, including things like TV series, books, films and architecture. So trading goods and services is a key part, but keep in mind there's also two other aspects to our balance of payments on the current account. The first is called net primary income. Now, primary income is basically the income that a country manages to generate from their overseas investments. You might have some shares in an overseas company, you might have some property which generates rental income, you might have some savings in an overseas bank account, you might have some migrant workers who live overseas and sending money back home. They would count as inflows of primary income. Of course, there's reverse flows from overseas workers living, for example, in the UK, and from foreign investment in the UK, where the profits get sent back to the country of origin. But we're looking for the net figure. Likewise, the net secondary income includes things like aid payments, humanitarian aid, bilateral aid. There could be some debt relief there, military grants, and of course the UK for the moment, for the next year or two, is inside the EU, so the payments we make to the European Union would count as an outflow on the current account. The capital account is actually not that significant, if truth be told. I wouldn't worry too much about the capital account. All you need to know is actually relatively tiny in the bigger context of things. It's a bit like Donald Trump's inauguration attendance. It's really tiny and insignificant. That's a joke, by the way. But it includes things like the sale and transfer of patents. A British firm, for example, might buy a patent off an overseas company. That would be an outflow in the capital account. The selling of franchises and leases and other kinds of transferable contracts. And debt forgiveness, debt cancellation is on the capital account. So if we forgive some of the debts that maybe other countries owe us, that will count as a negative on the capital account. Don't worry too much about the capital account. I don't want you to get worked up too much about that. What really matters is the financial account. So the two key core parts of the balance payments, the current account and the financial account. The financial account is essentially all of the inflows and outflows of capital, all of the transactions that result in a change in the ownership of an asset or liability between the UK, and in our case here, or non-residents. So for example, net inflows of foreign direct investment will be a plus on our capital account. If Nissan chucks another $500 million worth of investment in its Tyne plant, that's a plus on the foreign investment account. Money might come into the UK, I don't know, Russian money buying London property, or American investors deciding to put their money into the UK stock market rather than the United States. That will be an inflow of portfolio investment. There are also quite big banking flows across countries. That's sort of short-term hot money, flitting from border to border, looking for the best rate of return. And crucially, governments also, through their central banks, have to each year make a change to the value of their reserves of gold and foreign currencies. We'll come back to that in a second. FDI, quite important on the financial account. It's a significant economic issue, and we actually have a separate YouTube video on FDI worth checking out on our YouTube channel. But FDI is basically any kind of international investment flow. Inward investments are positive to the UK balance of payments accounts. If a foreign firm builds a manufacturing plant in the UK, or Primark from Dublin decides to invest more stores in England and Wales and Scotland, for example. Outward investments are negative for our financial account, so UK businesses investing overseas. Portfolio investment is basically people and businesses from one country buying shares or other assets, other securities, including bonds, in other nations. So if I buy some shares in Google, that's a portfolio outflow from the UK. If a German investment bank, Deutsche Bank, for example, buys some of the UK government debt, that's an inflow for the UK. Here's a neat, tidy slide which summarises the balance of payments across the whole piece, and I think it's one of those things I'd definitely probably print out for my notes. The basic story is that a country is trying to pay its way internationally, so we're trying to capture all the inflows and outflows. So the current account is kind of the trade and income account. Hopefully the inflows and the outflows are more or less balanced. They don't have to. Capital account isn't that big, if truth be told, so don't worry about it. It could be minus, could be plus, don't worry too much. The financial account is huge, but again the net figure tends to be relatively small. The balancing item in red is there for estimated errors and omissions. Some people think it's a bit of a con, but actually we do make some mistakes in the figures and we do need to balance the account up eventually. Essentially what happens is that if the current account's in deficit and the financial account isn't quite sufficiently positive, we then reduce our official holdings of gold and foreign currency, and that is counted as a plus in the account if we cut our reserves, and that helps to balance things up. The balancing item is there for errors and omissions. It's normally a few £1 billion a year, nothing to get too worked up about. So overall, if you're at a dinner party or a supper party and somebody says to you, what do you think about the balance of payments at the moment for the UK? Just say, well, I'm not actually too worried. It's zero anyway, and can I have another helping of the salad, please? What matters, if you're running a current account deficit, is whether you can attract sufficient capital to be able to balance the books. So the current account balance plus the financial account is the extent to which the UK is a net lender if it's in surplus, or a net borrower if it's in deficit. Basically, the story is that countries that run current account deficits tend to have to attract capital. They tend to be borrowers of money in the international financial system. So the UK has a 5% current account deficit. It needs to attract some capital inflows to balance things up. Equally, on the other side, some countries like Germany and China and Norway and Singapore, they run big current account surpluses. As a result, they can run a capital account deficit. They can use some of their surplus dollars, for example, to make investments overseas. Here's the figures for the UK. The orange line shows the trade balance in services. It looks pretty healthy, doesn't it? The service surplus been rising as a share of GDP. It's now nudging up towards 5%. However, our trade balance in goods, the deficit gets worse pretty much year on year. It's now down close to 7% of our national income. So -7 plus 5 gives you a trade balance of -2% of GDP, imports greater than exports. If we look at the current account as a whole, the blue bit is what we've just looked at. So that was the blue bit is the grey area, just trying to turn it into blue here. So we've got a current account deficit in the UK at the moment. In fact, all three components in 2015 were red, were negative. Transfer is always negative because the UK is a net donor of aid and we make our payments to the EU. It's always negative. But the thing that's turned around in recent years is the property income surplus, which we kind of used to rely on, has dipped quite a bit in recent times. Some UK industries have taken hits, for example, in insurance, in banking, BP in the oil and gas sector. Hopefully that will turn around in the years to come, but we can't rely on being a net income flow from our overseas assets at the moment. So there's our current account deficit, not in terms of GDP, but in terms of billions of pounds. It's nearly £100 billion. And therefore, we have to finance that. We do that by hoping to attract inflows of portfolio and foreign direct investment, including overseas buyers of property in the UK. So countries such as Britain run a current account deficit. Just having a sip of tea there. This is an external deficit. It's basically a net outflow of income from your circular flow. And as I've just repeated, deficit countries need to run a financial account surplus, for example, attracting hot money. Current account deficit countries are known as debtor countries externally. Current account surplus countries, Norway, Singapore, Germany, China, They run external surpluses. They have a net inflow of money into their circular flow. That allows them to run a financial account deficit. They can become capital exporters. Indeed, many external surplus countries, including Norway and China, have set up quite hefty sovereign wealth funds to invest some of their surplus money. Current account surplus countries are creditor nations, whereas current account deficit nations are debtor nations. Well, what causes deficits? We've got some separate revision webinars on this, but I just want to spend a few minutes on causation. Why is it that a country could be a persistent current account deficit nation? In part, the causes are both cyclical and structural. So a country, for example, on the cyclical side might have allowed their inflation to rise too quickly. Maybe they had a boom in consumer demand. So high inflation tends to erode your competitiveness. Or maybe on the supply side, you just haven't invested enough in new capital, you haven't been sufficiently innovative at the cutting edge, and your businesses are perhaps a little bit behind the curve compared to rival businesses in other countries. Oftentimes, in oligopolistic markets, the quality of design and branding and product performance and provenance of the product makes a big difference to your market share and your sales. In some countries, the current account deficit might be the result of the exchange rate perhaps being a little bit too high, causing exports to be priced out of overseas markets and imports to become cheaper. Or a third reason, highlighted on this slide, is that there could be a recession, fall in incomes and demand and spending in one or more of your major export markets. So, for example, the European Union, we export nearly half of our goods and services to the EU. If they go into a soft period of growth, Britain's exports might suffer. And it could be difficult to immediately switch from, let's say, the European market towards whatever, Ethiopia, Vietnam, Mexico, where demand might be stronger. Many countries, their current account deficit is volatile because they are heavily dependent upon the export of one or more primary commodities. Could be oil, could be gas, could be copper, all that kind of stuff. So maybe the world price falls, in which case their exports suffer, or they could be a net importer of those oil and gas and raw materials, in which case if the price of those things goes up, again their trade balance suffers. So the key causes are both cyclical and supply side. How to address this? How do you reduce the balance of payments deficit? Well, there are two main policies. One is expenditure switching and the other is expenditure reducing. Expenditure switching policies are basically designed to change the relative price of your exports and imports. For example, if the currency depreciates, exports should become relatively cheaper, priced in overseas currencies. Imports should become more expensive, priced in your currency. You would hope that would cause a switch in demand. Expenditure reducing policies, basically I call this the squeeze. They are policies that are designed to reduce the real income of consumers and thereby cut demand for imported goods and services. So higher interest rates or higher direct taxes could do that. It's important, I think, to be able to analyse and evaluate expenditure switching and expenditure reducing policies. So I'm not going to go through everything on this slide because we can do this in a separate video. But for example, you could introduce import tariffs as an expenditure switching policy, make imports more expensive, make domestic producers more competitive. But of course you risk retaliation, a trade war perhaps from other countries if you're using your tariffs specifically to improve your trade balance. On the expenditure reducing side, you could, for example, increase income tax to reduce disposable incomes and reduce demand for imports. However, an evaluation point, there are plenty, but an evaluation argument could be that higher income taxes would not just affect living standards in the short term, which the people worse off, but perhaps could damage work incentives in the labour market. So when you revise trade adjustment policies, be willing to do your chains of reasoning, but also be able to evaluate some of the risks and the downsides of each. Keep in mind, we'll do a separate topic video on policies on balance of payments. You'll be able to find that on YouTube. Let's finish with a couple of questions. Here we go. The diagram shows the UK trade balance with China and Japan in 2003 and 2004. Here's the question. How did the trade balance of the UK change between the start of 2003 and the end of 2004. Have a go, press the pause button, have a go. I'll be back in a few seconds. And the answer to this question is C. Hopefully you got this right. You can see that the imports from China went up and our exports went up a little bit, but actually not as far. So our imports were rising faster than exports. So there was a trade deficit to start with. That would have got bigger. With Japan, our imports from Japan actually nudged down a little bit and our exports to Japan went up. So the trade deficit with Japan would have fallen. The answer is C. Time for one more question if you're still with us. Question 7. Assuming that the supply of exports and imports are perfectly elastic, fine, at which combination of elasticities of demand for imports and exports would a 10% depreciation in the currency lead to a worsening of the trade account of the balance of payments? Do you recognise the concept we're testing here? Have a go at the question. And the correct answer is A. This is about something called the Marshall-Lerner condition. And the condition is that a depreciation of the exchange rate will improve the trade balance if the sum of the elasticity of demand for exports and for imports is greater than 1. And of course, or equal to 1. And this A is the only option where the sum is less than 1. It's 0.75. So actually a depreciation, other things being the same, would actually cause the balance of payments to worsen, partly because we're going to spend a lot more on imports because the elasticity demand is pretty low. So we're going to buy the same quantity of imports but have to pay more. That question is really about the idea of the J-curve. The J-curve is an interesting idea in economics where if there's a depreciation of the exchange rate, initially, if you start off here with a trade deficit, initially 3 or 4 months, maybe 6 months, the trade deficit actually gets worse before it gets better. If the Marshall-Lerner condition is met, there should be a net improvement in trade. My strong advice to you for the exam is not necessarily to draw the J-curve heading up in this sort of vertical way up here. I would keep the trade deficit negative. In other words, keep the trade deficit, but just show the improvement in the trade deficit. This is close enough to a J, of course, to call it the J-curve. We always leave you, those of you who are watching the YouTube version of our webinar, we always leave you with some key definitions in case you want to print them off or just write a few definitions down. So here they are. There's quite a few key definitions there. And keep in mind, of course, we've got our glossary, our A-level economics glossary, key terms, 60 pages of glossary terms covering micro, macro, business economics, labour markets, financial economics, behavioural. That's available on the website for a nice tidy sum. All of our webinars, our weekly webinars, which become twice weekly pretty soon, are available on our YouTube site. We love it when you join us for the actual live sessions. So as a group, we can test ourselves on some questions. I'm at TutorTubeJeff if you want to keep the conversation going on Twitter. Loss-making Twitter, as we found out today. Thank you very much for tuning in to this revision webinar on the balance of payments. Keep the revision going. It's always worth it. And hopefully we'll see you again sometime soon.